Welcome to Market Wrap number 128. Stuart Williamson here at the helm. APW. This is our weekly roundup of information on the UK residential property market that people who are buying in the UK may find useful and may want to make use of. So please like, subscribe and share and help us help more people. Remember, don't miss the podcasts which are out there on most common providers by Paul Shearer, the respected financial journalist. Okay. Mr. Hunt produced the autumn statement. He said the statement aimed to restore stability to the economy, protect high quality public services and build long-term prosperity in the UK. We're going to cover that now in the short term, talking about what it means to us as individuals. He said it was going to stop inflation eating into paychecks and savings and disrupting business growth plans. So the second part we're going to cover is business growth plans and what he's done means to the overall economy. So what measures did Chancellor announce to try and lower inflation, and how will the residential property market be effective for investors directly? Despite tax rises dominating the headlines, there are a number of measures announced which will please property investors. Mr. Hunt said that all taxpayers will be asked to contribute, but those with the broadest shoulders will be asked to generate a greater share, i.e. those with more money. A reduction in the threshold at which higher earners start to pay 45% tax went down from 150,000 to 125, 140. As well as a further 2-year freeze on income tax, national insurance and inheritance tax thresholds in April 2028. I mean, that must be close to 20 years since IHT was changed, which is a massive tax grab. So don't be kidded by these figures. The national insurance contribution thresholds for employers will be fixed until April 2028 and will continue to mean that 40% of all businesses don't pay any at all, which is amazing. I didn't know that. The divided allowance will be reduced from 2,000 to 1,000 in April next year and then to 500 from April 2024. The annual exempt amount for capital gains tax will also be reduced from 12,400 to 6,000 next year and then lower to 3,000 from April 2024, and that will have quite an effect on smaller investors and second home owners. Okay, stamp duty cuts announced by Mr. Kwarteng in his mini budget will remain, but will be time limited, ending on 31st of March 2025. So that's very positive for people who are buying lower entry properties. From our perspective as expatriates, it's not going to affect us because we have to pay we're buying investments anyway. There were some more positive announcements alongside Mr. Hunt's plan, which were on the basis of stabilising the economy on a more national scale, which will affect overall market trends as opposed to individuals. And we need to look at those, and we're looking at where are the best places to buy around the UK in these troubled times. Levelling Up update. At least 1.7 billion will be awarded in a second round of Levelling Up awards. Nearly 500 million more than was in the first round last year. However, only 187 from the first round has actually been released of the 1.24 billion that was supposed to be paid out. So will it come to fruition? That's a bit of a frilly sort of thing, I think. Infrastructure investment. More than 600 billion will be safeguarded for capital investment over the next 5 years. Business rates relief. A 13.6 billion package of support on business rates is being worked on, including the increase of relief for retail, hospitality and leisure sectors up to 75%, which are the areas that really were spanked by COVID and need the help. The Northern Powerhouse rail support. This statement used the term Core Northern Powerhouse Rail when describing the rail project, which goes against what Liz Truss said. Liz Truss said basically that the full project would be going ahead. Great idea, but not written in any financial good scope. The Treasury has confirmed that the Northern Powerhouse Rail project promised in the budget is the same as described in last year's integrated rail plan, which basically means HS2 to Manchester and East-West Rail. East-West Rail is crucial for getting across to Suffolk and Norfolk, and that seems to be one of the focus areas they're looking at. which I'll get onto in a moment. Social rent caps. Rents on affordable housing can only be increased by 7% maximum in the next fiscal year. That was quite a result because most people thought it'd be 5%, which would have had a knock-on effect on social housing, which isn't great. Solvency II. Now this is a big thing, again, which not many people are aware of. The EU had a certain way of doing things, and Solvency II will unlock tens of billions of pounds of investment by UK insurance companies. And this will be done by letting the pension funds and the insurers take a more relaxed view of risk and keep smaller cash buffers, so the liquidity ratios will be less. And to quote subplot columnist David Tame in his 24 March column, Tame spoke to Collier's chief economist, that's Collier's, the property company, chief economist Walter Birchker, who described the reforms as potentially transformative and potentially staggering as to how much money will be released for investment for UK insurance companies. Devolution. Doubling up on the idea of February's Levelling Up white paper, the government has said it is working with Greater Manchester and West Midlands local governments on a new trailblazer devolution deal, which the government wants to deliver by early 2023. Now this, I thought, what, devolution, what is all that about? And it really piqued my interest. So I did a fair amount of further research on it, and just to summarise very quickly, there's a great report in Business View, and it says the government has restated its commitment to agreed trailblazer devolution deals with Greater Manchester and West Midlands councils that will see more powers devolved in areas including skills, transport and housing. The proposed extended deals came out of a Levelling Up white paper by Michael Gove, who was then under Rishi Sunak and is now again under Rishi Sunak, the Levelling Up Secretary. However, the 5-month hiatus between the two and the wider political uncertainty and turmoil has hindered progress on this. But deals are now expected to be agreed in early next year with the Metro mayors of Andy Burnham and Andy Street, which would then provide a blueprint for other areas to follow. So devolution appears to be back on the government's agenda as the Chancellor Jeremy Hunt announced these new deals also for Suffolk and Norfolk and an area in the northeast. So basically he says they're making progress towards trailblazer devolution deals with Greater Manchester Combined Authority and West Midlands Combined Authority. And he goes on to say, and says, soon over half of England will be covered by devolution deals taken together. It doesn't discuss Wales, I'm afraid, or Scotland, I'm sorry about that, but it's just focusing on England, this particular report. The government is also discussing with 2 combined authorities about the potential to provide single departmental style settlements at the next spending review, with the aim of moving money away from competitive bidding processes. So go to places that aren't necessarily the most competitive, but could do with the money to make it better, so helping poorer parts of the country. Now, investment zones were a key of Truss Kwarteng's approach, but Sunak and Hunt have decided to refocus the programme instead of having heaps of different authorities, and I think Kwarteng and Truss had 40 investment zones in mind, and they asked local authorities to put in bids for it. Basically, Hunt has binned all that and says, no, we're not having that sort of stuff. The investment zones strategy will be limited to a number of highest potential, knowledge-intensive growth clusters. He said that the investment zones will now focus on leveraging our research strengths by being centred on universities in left-behind areas to help build clusters for our new growth. That's basically Suffolk and Norfolk, and then the northeast somewhere. But they're focusing on the first devolution locations in the coming months, involving devolved mayoral and local authorities being in the East and West Midlands and in the Manchester area. Now this could be huge, I think, for where is a good place to buy going forward. Jones Lang LaSalle have already reported, I think last week, 2 weeks ago in the Market Wrap, that central London, central Manchester, central Birmingham and Glasgow, Edinburgh were places to buy. And we're going to get a 2-tier growth, which I think we are. Some of the other areas are going to get left behind. So that could be important when choosing where you wish to buy to make the best possible return on your investment. So there we go, that's it for this week. Do like, subscribe, comment, all that sort of stuff. It's a bit off the cuff this week. I just thought I'd try and do something different. Thanks for listening. Share, subscribe, and if you want more information, fill in the form at the bottom and we can crank out some more information to you. Take care, cheerio, and it's only about 5 sleeps till Christmas. And for the gentleman who asked me, do I wear a Santa suit? I will do. Bye.